In the last video, we took the 15-minute opening range breakout strategy and we optimized the parameters of stop loss, take profit, day of the week, and time frame. In this video, we're going to be doing something 2 to 3 times as important. We're going to be covering 4 different stress tests to see if the strategy has the capability to perform properly in a live market environment. Overfitting your data is a common occurrence that happens when you're doing basic optimization on your parameters, and it's important to really break down and tear apart the strategy to ensure the optimized P&L, win rate, and drawdown are realistic assumptions of what would happen in a forward test with real capital. With that being said, let's get into the data. This document is prepared by Bainbridge Capital for informational and research purposes only. It does not constitute investment advice, solicitation, or an offer to buy or sell any financial instrument. Past performance is not indicative of future results. All backtests are hypothetical and subject to inherent limitations of simulated trading, including survivorship bias, look-ahead bias, overfitting to historical data, and inability to account for real-world market conditions. The strategy described herein has not been audited by any third party. Results may differ materially from live trading due to slippage, commission, liquidity constraints, and market regime changes. Trading futures involves substantial risk of loss and is not appropriate for all investors. All right, so here we have the NQ Opening Range Breakout, Part 2. We're going to be doing stress testing and robustness validation from 2020 to 2025. We're going to be doing slippage analysis, walk forward out of sample analysis, Monte Carlo, and permutation tests. Really, we're asking the question, is this a genuine edge or is it 6 years of well-fitted, overfitted data? At the bottom left, we have a little bit of a sneak peek of some of the things that we cover. As you can see, we had 75,000 in out-of-sample P&L. 4 out of 4 of the out-of-sample windows were profitable. We had a really good score on the permutation test, and our slippage did not suffer too much. So we have 4 tests and 1 question. We have slippage analysis, walk forward validation, Monte Carlo simulation, and a permutation test. Slippage analysis is where we apply 0, 1, 2, and 4 ticks of slippage per side. We measure impact on all key metrics. We're essentially asking and validating robustness under execution costs. We've already included commission in this, so this is just an extra step. In the walk forward, we're going to be training our data on 2 years. When I say training, I mean optimizing. So we're going to be doing sort of what we did in the last video, where we optimize stop loss and take profit on 2 years of data, and then we're going to be testing it forward on the next year. This is going to be repeated across 4 rolling windows, and we're really just seeing if there's a out of sample performance check. It's a really good way to do a forward test efficiently without having to apply the strategy live and wait for every single trade to come through. Instead, you can kind of mend the data to assume that it's going to be walked forward or doing a forward test on a completely different environment, if that makes sense. Monte Carlo simulations, where we're going to be reshuffling all of our actual trades 1,000 times over. This measures the P&L and the drawdown distribution. This shows us essentially where our P&L and our drawdown land in a world of 1,000 different simulations where the strategy was executing trades. This shows the realistic range of outcomes. And last but not least, in my opinion, one of the most important is a permutation test. This is where we generate 1,000 random strategies using the same data. We're going to compare our own result to that distribution. This tests if the edge could appear by chance alone. So for our first stress test, this is the most simple, the most basic, and in my opinion, I knew this test was not going to make the strategy suffer too much. Slippage is essentially the difference between the price that you wanted the strategy to take place at and the price that the order was filled at. It's not a huge problem, but in strategies that have high amount of trades per day, for example, scalping strategies or high frequency trading, slippage is really, really important, and just increasing the slippage by 1 to 2 ticks per trade can entirely destroy a strategy. I knew this one was going to be not much of an issue given that this strategy trades once a day, so we're really statistically only going to see a little bit of a degradation. So on 0 ticks, as you know, we had 166,000 in profit, and as you can see on 1 tick, we had 160,000, 2 ticks, we had 156,000, and 4 ticks, 139,000. The equity curve does not suffer whatsoever. It just reasonably so drops down in profit as we increase the slippage. On NQ, 1 tick of data is $5, so 4 ticks assumes 1 whole point, which is $20. So essentially what we're doing in the 4 ticks is subtracting $20 from every single trade that is placed. Additionally, our Sharpe did not suffer too much. At 0 ticks, it was 1.32, with the worst result in this case scenario being 1.11. For the most part, 4 ticks of slippage on every single trade is extreme, but as I've said previously, it is good to be extreme, it is good to be conservative, it is good to be critical when we are going through these strategies. This shows the win rate, the profit factor, the max drawdown, and the Sharpe ratio. This isn't something to really dwell on too much given that the strategy trades once a day. It's just good to know that when you assume 4 ticks of slippage, the strategy still upholds itself with 140,000 in profit and a $23,000 drawdown. Sharpe stayed strong. Profit factor, like I've said, has been weak on this strategy as a whole, but that doesn't mean it's not worth testing. Now, for the walk forward out of sample analysis. As I said before, we take 2 years of data, we optimize the parameters of the stop loss, the take profit, the time frame, and the day of the week, and then we find out which combination of those 4 parameters is the most successful, and then we take it and we test it on the year forward, a year that was not properly optimized. Like I said previously, this is a great way to do an efficient forward test without actually sitting there and waiting for the trades to execute over X amount of months, years, etc. This just briefly shows you how the windows are structured, just so you can see a visual example. When it says train, that just means optimize, and the add a sample is the forward testing result. It's commonly called steps, so we had 4 steps in this, and that's essentially just the 2 years of trained data, and then the 1 year add a sample, that is 1 step. We go down once and move forward a year, we test it on another 2 years, and then the next. What's interesting is our P&L did suffer a good amount. We're still profitable in all 4 windows, which is a great thing. We do not want to see a complete fall off in any single one of these steps, and if you wanted to be more critical with this, you could do a year of trained data and then 6 months. This is a relatively basic walk forward, and since we've done 3 other stress tests, there was no need to go completely in depth. Within our own personal portfolio, we will run multiple different types of walk forward tests just to ensure a strategy has edge and it's not a complete waste of time. Our Sharpe ratio degraded very severely, however, in step 3 and 4, or walk forward 3 and 4. We had a Sharpe ratio of 0.79 in walk 3, and in walk 4 a Sharpe ratio of 0.28. Looking at the total out of sample performance, the equity curve is once again very, very important. It's great to take this equity curve and compare it to the optimized equity curve to see how much of a difference there really is. In the last video, our optimized equity curve was a lot smoother. While we did have flatlining periods, we didn't see as much jaggedness in the trades. However, in the out of sample, it really exposes where the strategy has its weaknesses. To start, we see a big drawdown in the beginning, large spikes up and spikes down. In this region, we even dropped off a good amount. Even though it recovered, it still flatlined and then proceeded to drop down again. Flatlining is obviously a bad thing. However, what we really don't want to see is the jagged flatline where we're just making and losing money in a repetitive and exaggerated manner. Another interesting thing to note was 2024 was actually our best year on optimized data, and in the out of sample performance, it was the 3rd worst. That shows you not to rely on optimized data. Our worst performance was actually in 2025, which is very notable because the walk forward analysis essentially took 2023, 2024, optimized the data, which we know the 2024 data was very profitable, and when it tested it forward on 2025 parameters, it did not do well and was our worst performing step. A big red flag is also seeing in 2025, our max drawdown was 21,000, which is equivalent to the total drawdown over 6 years in our optimized data. We still remain profitable in 4 of the 4 windows, and the overall profit was $75,808. So in my opinion, this isn't enough to completely abandon the strategy, but it is always worth noting. Now for the Monte Carlo simulation. So the Monte Carlo simulation is a technique that randomly resamples the actual trade results thousands of times to generate a distribution of possible outcomes. It's used to assess the range of realistic P&L and drawdown scenarios independent of the specific sequence that trades occurred in. It allows you to gauge the success of your optimized data and compare it to 1,000 other scenarios. This is really helpful in expectation and expecting how your drawdown may perform and your P&L as well. So once again, our actual P&L was 166,000. It was good to see the median Monte Carlo P&L was 168. Our worst performing P&L out of the 1,000 trade sequences was 68,000. That is the worst 5% outcome. And the best case scenario, the 95th percentile, or the top 5% in outcomes, was $262,000. This Monte Carlo curve is simplified. What you'd actually see is 1,000 other equity curve lines in a similar sequence. The green line obviously represents the top 5%, with the red line representing the bottom 5. The dotted white line is our median. Once again, it is simplified. The actual equity curve is most likely more jagged. For example, in the 5th percentile, we were probably in a bigger drawdown, and it wasn't this smooth curve up. What I find most important is not profit and loss, it is the drawdown itself. On the right, we have a chart that visualizes the performance of our drawdown versus the other trade sequences. On this chart, it actually goes from left to right in the worst drawdown to the best drawdown. We're going to want to see our yellow bar here, the actual drawdown, aligned around the middle of this chart or even farther to the left. What we did see instead was our optimized drawdown performed better. You may think that's a good thing, but it shows a chance of possible overfitting when it came to our optimization. The worst 5% drawdown that we saw was 52,000. That is not necessarily saying we should expect 52,000 in drawdown if we were to forward test a strategy. That just means that that was one of the worst case scenarios. One of the most important data points is the median max drawdown, which in this example was $31,028, roughly $10,000 worse in drawdown than our optimized data. This means that when we're paper trading a forward test or even using live capital, we should not be expecting 21,000 in drawdown. We should be preparing and approaching risk management with a mindset of around 31,000 in drawdown. This can change your sizing in your positions and contracts by a very large margin. It can even be a deciding factor in whether or not you want to implement this strategy into your own portfolio. While the median drawdown is worse, I will say the strategy still remained profitable. The worst 5% outcome drawdown was still less than the total P&L, and I would say it passes the Monte Carlo test. So now we're on to the permutation test. The permutation test is a statistical significance test that compares a strategy's performance against a distribution of randomly generated strategies using the same data. The resulting p-value quantifies the probability that the observed edge could have occurred by chance alone. Other than slippage, our strategy actually performed the best in comparison to the Monte Carlo and the walk forward out of sample when it came to this, which is definitely a confidence booster when it comes to the 15-minute ORB strategy. When it randomly generated strategies on the same data, the permutation median was 1,054 in PNL, and the average permutation Sharpe was actually negative 0.007. As you can see on these charts, we have our real performance compared to the performance of the random strategies. On the left, we have the P&L. As you can see, the p-value was 0.001. This means that 1 in 1,000 of those random strategies either had a P&L that beat the optimized data or was equivalent to it. On the right, we have the Sharpe ratio. Our p-value was 0.000. That again means 0 out of 1,000 strategies beat or had an equivalent Sharpe ratio to the optimized data. This shows that the strategy edge is statistically significant and it's extremely unlikely to have occurred by chance. We're always going to want to see the spacing in between the random strategy results and our optimized, and it proves that the strategy logic is sound. It is genuinely reading the market and performing with a real edge. So overall, let's look at the results. Instead of starting with slippage, we're going to start with the walk forward out of sample. Given that if this strategy passes all 4 of these tests, it would simply be enabled on a paper traded account to be forward tested for 2 to 3 months. So with that, we're not going to be lenient when it comes to these stress tests, but we're going to want to look at the basics and not be insanely critical of the results. So the walk forward out of sample edge actually held up. Even though we saw a decreasing performance in the second half of the data, it still remained profitable. The equity curve was not the greatest, but once again, walk forward analysis is a rigorous test, and to remain profitable is a good sign overall. It had a total P&L of 75,000 across 826 unseen trades. The parameters from training transferred relatively clean to the test here in every window. For 2, the Monte Carlo outcome range is acceptable, with a median simulation of 168,000 and our 5th percentile, bottom 5%, still being profitable. This means the actual result sits above the median, and that shows a solid performance, not just a lucky outlier. For the permutation test, we saw our best performance and saw that the strategy is statistically significant. We had a p-value of 0.001 on PNL and 0.0 on Sharpe. So fewer than 1 in 1,000 random strategies actually matched or beat our current one. This means the edge is extremely unlikely to have occurred by chance on this data. For 4, we have slippage. This is easily assumed. We are profitable at all tested levels. At the worst case, 4 ticks per trade or $20 per trade, we still had a profit of 139,000, a Sharpe above 1.0, and a profit factor of 1.16. The strategy absorbs realistic execution pressure and remains solid, even with commission involved. Our final verdict, the 15-minute opening range breakout strategy on NASDAQ has a genuine structural edge. With it passing 4 independent tests, it shows that the edge is real. With that being said, the 2024 concentration risk we covered in the last video remains the key live trading caveat to monitor. Now, what's very important to mention, does this mean we're going to deposit 10,000 in a brokerage account and just trade the strategy with the highest leverage possible because we saw it pass these 4 windows? No. This just shows that the strategy is worth paying attention to, it's worth enabling on a simulated account, and tracking the forward tests over the course of the next 2 to 3 months. Not only are we going to be monitoring the win rate, profit factor, the P&L, and our Sharpe ratio, we're also going to be looking for execution errors, making sure that the strategy logic is sound during automation, and making sure the losing streaks and winning streaks properly represent what we saw in our optimized data. Whether or not you trade the 15-minute ORB strategy, I hope you found this analysis useful. I hope it proves to you the importance of backtesting and looking at trading in a quantitative perspective. If you have any questions about our process, feel free to contact us through email, drop a comment, or visit our website, oldbainbridgecapital.com. If you'd like the same analysis to be done to your own strategy, whether it's discretionary or automated, please visit the website. Here you can see our process. We do backtesting, optimization, stress testing. We can do one of the 3 for you or all 3 if you'd like. Just click services and you can look at the specs of our baseline backtest, our optimization plan, and the full research engagement. If you're interested in any of this, just click get started anywhere and it'll bring you to our contact page. Here, just put in your name, email, phone number, the service that you're considering, and a small definition of your strategy. From here, we'll arrange a 15-minute call. I'll be able to quote you, and we can discuss the best way to bring your strategy to that next level. If you're interested in learning how to do backtesting yourself, optimization, or stress testing, and even automating your own trading strategy, just go to our website, scroll to the bottom, or click Learn at the top right. There you'll be able to input your first and last name, your email, and you'll gain updates on our growing research library, learning the full backtesting process, and applying institutional level analysis to your own trading strategies. We hope this video has shed light on the quantitative aspect of trading, and if you want to learn more, please feel free to reach out.